the NASDAQ, we're looking at the S&P, so we'll use the S&P so that we're comparing like with exactly like. So let's take the S&P as the narrative. And a lot of times the S&P is a lot thicker liquidity, so sometimes the order flow is not as clear on the S&P versus the NASDAQ because of the thickness of it. But this is a good example that I thought was worthwhile mentioning, because we've got a situation here where we start to see, now where did the market become bullish? Well, it was at 1548, right? So 1548 and the market becomes bullish, which was obviously on this sweep here, right? So that's where we got bullish value. Now, one of the things, first of all, you can notice is these beautiful pink Voltics. Do you see them? Beautiful pink Voltics right there. And remember, that's the point, 1548, if you remember. 1548, that's the point where the market actually went bullish right there. So the Voltics give us a strong sense of the right trade. Now, one of the things we notice is what was the delta doing at that point? There's too many buyers, isn't there? Say it out loud. Say it really out loud. There's too many buyers. So in other words, even though you're bullish, you recognize that there's too many buyers. Because with the value developing in here, with the value developing, for example, in here, you're already recognizing, wait a second, the delta is almost identical. There's too many buyers mimicking volatility pricing. Do you see that? You see that? Too many buyers mimicking volatility. So because the buyers are all buying because of the volatility, you know that the price is going to run the sweep to the downside. Have we lost volume again, have we? Absolute shit. Right, so I'm going to come out and come back in for 2 seconds.